Silver investors. Yesterday's candle wasn't just noise. It was the market drawing three bright red lines on your screen. 87 held, 104 is on the map, and 81 is where the floor turns into a trapdoor. I'm OG John AG, and in this video we're going to turn that one forecast into a full 20-minute roadmap, why yesterday's bounce from $87 is more important than the war headlines in your feed, why multiple models now point to 104.35 as the next serious upside magnet, not just a random number, why a clean breakdown through 81.05 doesn't mean small dip, it means full trend cancellation with risk down to 74.85 and even lower panic zones, and how you can build a position plan that survives both paths instead of praying one of them doesn't happen. This is not financial advice. This is one of those episodes where we stop arguing feelings and let the chart itself tell us what the battlefield looks like. Segment 1, what the chart actually says, not hopium, hard levels. Let's start with the March 3rd technical forecast. A lot of traders are quietly using as their base case. Here's the core. Silver price at the time of that forecast, around 87.23. Price continues to move within the framework of a bullish channel, even after the recent decline. Moving averages are pointing up, confirming upward pressure. We're still above key signal lines. Their primary scenario reads like this. We should expect an attempt at a bearish correction and a test of the support level near 85.75. From there, an upward rebound and continued growth in silver with a target above 104.35. Translate that into plain English. The market was supposed to dip into the mid-80s. It did. As long as that zone holds, the default expectation is a push toward and above 104. So if you saw 87 on your screen and thought crash, the forecast seeding institutional decisions saw a perfect test of support inside an uptrend. That's the first mental flip. You're not looking at a dying market fighting for its life. You're looking at a healthy trend pausing exactly where it should in a war-driven volatility regime. Segment 2, zooming in. The anatomy of the 87 bounce. Let's slow the tape down. Over the last few sessions, silver pushed up into the mid-90s. Sellers stepped in and drove it down into the high 80s. Somewhere between 85.75 and 87, buyers said enough, and price turned. Why that band? Because technically it's doing three jobs at once. Old resistance, new support. Earlier in the move, that 86-88 area acted as resistance. Breaking above it turned it into support, a classic role reversal. Channel midzone. On many 4H and daily charts, that region lines up with the midline of the bullish channel. In strong trends, pullbacks often stop at the channel midline before continuing. Moving average confluence. Shorter-term MAs, like 2050 EMA, are bunching up around that region. When price comes back into a cluster of upward-sloping MAs and bounces, that's exactly what trend traders want to see. So the 87 bounce is not a random V-shape. It's the market retesting a broken resistance, confirming it as support, respecting the channel structure. In other words, the first test of whether this bull move is real or a head fake passed. Segment 3, mapping the bull case. 87, 90.35, 99, 104.35. Now let's build the entire upside path from this forecast and related analyses. The March 3 forecast gives us support 85.75, intermediate resistance 90.35, main target 104.35. Here's how that plays out in steps. Step 1, hold 85.75, 87. As long as daily closes remain above this band, the bull channel is intact. Every dip into this zone is, by definition, a higher probability buy than a short until proven otherwise. Step 2, take back 90.35. That level is flagged as a key resistance intermediate zone in the same forecast. A daily close above 90.35 tells you the 87 bounce wasn't just a dead cat move. Bulls are actually regaining control of momentum. Step 3, attack the 99-100 band. Another detailed technical piece from late February marks about 99.56 as the 61.8% harmonic resistance on a larger structure, with a full psychological band at $104 as the next major test. Step 4, tag 104.35. The March 3 forecast's main target sits at 104.35, right inside that psychological band. It lines up with prior swing highs, channel top zones, and Fibonacci projections. So the roadmap is 87 support, reclaim 90.35, test 99 to 100, stretch into 104.35. You don't have to hit every cent. You just need to know what progress looks like when the market is following the script and when it's tearing it up. Segment 4. Why 104.35 isn't hopium, time cycles and volatility. A second analysis published February 23rd framed this move inside time cycles and volatility. Key points from that piece. Silver is in a volatility breakout phase as March time cycles come into play. Major volatility expansions historically follow periods of tight range and suppressed moves, exactly what silver did around 72.80 before it broke up. First extension targets cluster around $99.104, then $115.122, with an extreme extension near 141 plus in a true blow-off. So 104.35 is not the craziest target on the board. It's the first full extension inside a volatility regime that's only just waking up. Combine that with the macro backdrop, COMEX delivery stress, Shanghai premiums, Middle East war and oil shock, multi-year structural deficits in silver. Now ask, is a move from 87 to 104, about 20%, over 3 to 8 weeks really outrageous? In this environment, 20% is a normal month in silver, not a once-in-a-lifetime spike. Segment 5, mapping the bear case, 81.05 break, 74.85, deeper panic zones. Now we flip the chart and talk about pain. The same March 3 forecast doesn't sugarcoat it. A decline and breakout of 81.05 will cancel the upward trend in silver on March 3, 2026. This will indicate a breakout of the support area and continuation of the decline below 74.85. So 81.05 is your line in the sand. Above 81, you're in a bull channel with a 104 target. Below 81, the trend is officially broken in that framework. The model then looks down to 74.85 as the next objective. Other work backs up the idea of a mid-70s demand zone. Harmonic mean reversion analysis has the second buy zone around $76.93, with even deeper contingency levels at $58 and $39 only in a true crash. Earlier Market Pulse analysis showed silver pausing its sell-off around the mid-70s as well, marking it as an important longer-term pivot area. So the bear roadmap is lose 81, target mid-70s, roughly 74 or 77. Only below that do you enter true liquidation territory. That doesn't mean 75 will automatically print if 81 cracks. It means that's where the next big battle would likely be fought. If you're leveraged long and 81 goes, you're in the danger zone. Segment 6, building a plan around 87, 81, 75, 104. Now the part most people skip, turning this into a position plan. Let's say you're bullish on silver for macro reasons. COMEX stress, deficits, war, but you respect the chart. Here's one way to think. Time frame check. If you're trading hours and days, these levels are life and death. If you're stacking for years, they're value zones, not existential threats. Define your core view. Core view. Above 81, silver is in a bullish channel with a path to 104. Below 81, you expect a washout towards 75 before the next big move. Entry logic. First scale, dips into 87.86 with clear support reaction. Second scale, if the market ever panics into 75.76 on fear headlines, that's your deep discount buy zone based on the same models that gave you 104 on the upside. Risk line. For active trades, a hard stop or mental stop just below 81 respects what the forecast explicitly says, trend canceled. For investors, 81 break is not a sell everything moment, it's a expect volatility and have cash ready for 75 signal. Profit taking. For the 87, 104 leg, consider partials around 99 to 100, first resistance band. Let a runner aim for 104.35. If macro gets crazier, COMEX issues, more war, bigger Shanghai premiums, you reassess for the next extensions, 115 plus, 140 plus. The beauty of this roadmap is simple. You don't have to guess up or down. You respond to what happens at 81 and 90, 35, and 99. Segment 7. Why these levels matter more in 2026 than they did in 2016. In a calm macro world, these numbers would just be technical curiosities. In 2026, they're sitting on top of COMEX March open interest of 429 nanometer ounces versus 100 Mallows registered metal, a 4-5x leverage on deliverable stock, a 6-year streak of global silver supply deficits, demand exceeding mine plus recycling every year. Shanghai and Chinese markets regularly paying massive premiums over Western spot, signaling sustained physical tightness. A Middle East war that has already sparked sharp moves in oil and gas, reviving 1970s-style stagflation fears. Technical levels don't live in a vacuum. An 81 break in a sleepy market is just a trade. An 81 break in a market where COMEX inventories are collapsing and China is bidding $20, $30 higher for physical is a global signal. Same with 104. Triple-digit silver in a calm world is a curiosity. Triple-digit silver when Basel III, COMEX stress, and war premium are all active becomes a headline that pulls in new capital. So when you mark 87, 81, 75, and 104 on your chart, remember, they're sitting on top of a macro powder keg. Breaks of those levels will likely be more violent and more meaningful than in past cycles. Segment 8. How to use this without losing your mind. Here's how I'd sum up the mental game. Don't worship any one number. 104.35 is a target, not a promise. 81.05 is a line, not a prophecy. Markets overshoot. Markets fake out. Expect messiness around clean levels. Let the chart define wrong if you're long from 87 targeting 104 and price closes under 81. The market didn't betray you. It did exactly what the model said would cancel your thesis. Separate trader brain from investor brain, trader brain. Obeys stops, respects 81, takes profits into resistance. Investor brain looks at 75 in a structural deficit plus war market and thinks, thank you. Stop expecting linear moves. We're in a regime where 4 to 6% daily ranges are normal for silver. A 20% move from 87 to 104 can be interrupted by multiple 5 to 8% dumps along the way. If you anchor to these levels and treat them as if then statements, you stop needing to be a fortune teller. You just need to be honest. If 87 holds and we reclaim 90.35, I'll lean into the 104 path. If 81 breaks, I'll respect the mid-70s risk and size accordingly. You've been watching John AG here, and I'm OG John AG. If this helped you turn 87 support, 104 target, 81 risk from a tweet into a full 3D roadmap you can actually trade or stack against, hit like so the algorithm doesn't bury it, smash subscribe with all notifications on, and drop a comment, 87 bounce. Are you aiming for 104 or waiting for 75? Tell me which path you're planning around and how you're using 81 in your own strategy, because on this channel we don't worship green candles or panic at red ones. We let the levels and the macro do the talking, and we act when math, not emotion, says it's time.